Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pagamak. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to provide you with guidance, give you advice. There's the disclaimer.
Excellent.
And let me share my screen. As I'm doing that, if anyone's joined us for the first time, quick note, Will and I, we do these shows in the morning to help answer questions you may have about the Market Chameleon tools, the data, or analytics. If you'd like to come on a show and ask your question live, we do provide a link to Zoom on that live chat on YouTube. So if you click on that, it'll take you over to Zoom. Once you're logged into Zoom, there's a button, raise your hand. Click on that. You could ask your question directly. If you prefer to type your question, just type that into the live chat on YouTube. Will's watching it. He'll read those questions back to me. And in the meantime, if while we're waiting for more people to join us and give a chance for people to put their questions in, we'll start out taking a look at the pre-market report to see if we could get some insights, what's going on in pre-market hours, and then we'll move on to the questions. All right, sound good, Will? So pre-market report, these are stocks trading in a pre-market hours. Let's first go down to this list, and we have a list of our most active stocks, our biggest percentage gainers, and biggest percentage decliners. So these are stocks that are trading in the pre-market hours and have to meet certain volume, price, and liquidity thresholds to make that list. And here we have 29 stocks that made our percentage gainers list, 55 on our percentage decliners list. Right now, from that perspective, it looks like we're setting up for a bearish bias at the open. We could also scroll up here and take a look at this calendar view. And this goes back in time to give a summary from a high level, what's going on in the pre-market hours. Today is August 14th, and this is so far what's going on in all the stocks that are trading in pre-market hours that are listed on a major US exchange. And here we have 314 stocks that are trading in pre-market hours that are higher than the previous trading day's close. And we have 399 stocks trading lower. If we look at the volume of shares, 129.3 million shares are trading on up volume versus 49.1 million shares trading on down volume. So here, that looks like a little bit of a different number, right? We have a lot more shares trading higher than we do lower, even though we have many more stocks trading lower. So if we convert those shares to dollar value, not every share is the same price. So sometimes you have stocks that are $1, some stocks are $100 or even more. So if we compare the dollar value of the shares trading in the pre-market, we see that $447.4 million worth of stock trading higher versus $2 billion trading on down volume. So here showing us that from a notional value, we're still looking like a bearish sentiment setting up in pre-market hours. Okay. One more thing. Let's come down here and filter this list. Right now, if you look closer at the list, there are a lot of symbols in there that are low cap stocks. Here are the market caps. There are ETFs, leverage products. It could be a preferred stock. Any security that's traded on the major US exchange, if it's trading at pre-market hours and meets our threshold, it'll make this list. To narrow down this list, we could use the filters above. And if you have a watch list, you can just filter by your watch list from here. But let's use this filter here in ETF. I'm going to drop it down and you get a list of ETFs to choose from. There are broad-based ETFs, sector ETFs, and I'm going to use SPY over here, the S&P 500 ETF. By clicking on it, we're going to filter out the list below by stocks that are holdings in the SPY ETF. All right, so now we got them grouped by S&P 500. Here we have 2 stocks that made our percentage gainers list, 7 on the percentage decliners list. And here that also shows us that there's a slightly bearish bias right now at the open. And, the only one, I guess, Tesla, the big one sticking out here, down 2.9%. So this is really quickly, just going over how things are trading in pre-market hours, but I guess we've given it a couple minutes, Will. So if we have questions, I'll move on to the question.
Well, we have a special guest who's going to come on live.
Okay, awesome.
We asked some questions Friday, but we did have one question that popped up from Igor that you may be able to answer quickly. He said, is there a way to get alerts when strategies in the watch list pass certain levels? I just thought you'd answer that real quick. I don't think there is, but
yeah, no, we don't have an alert system like that. So I'm not. I'm assuming you're setting up like an option strategy, and you wanted to get an alert if the strategy itself reached a certain price. Like, let's just say a simple one is like if you had a call and the call price reached a certain price. But we don't have an alert system like that because it would be complicated. And some people have a really big watch list. Some of these watch lists are really big, but the platform itself is really focused and concentrated on the research, right? Not so much that you have to react to something very quickly because something just happened, right? It's really based on the research and preparation and understanding the markets and preparing for the markets, right? So there's nothing in there that is pushing anybody to a high frequency trade, right? That you have to do low latency, high frequency, really fast speed trading. It's more of analysis where you could analyze the market, understand them, and you feel comfortable making informed decisions, right? It's waiting for something that really deviates potentially from its true price. Okay, so it's nothing where, and we try to stay away from that where, I think a lot of people get into trading thinking that they're competing in some kind of a race, but to act, and it's not like that. It's more of a competition of models, okay? Modeling and understanding the markets, anticipating and forecasting and pricing out the markets.
All right, there you go.
So, if there's somebody, if we have a guest that want.
Yeah, well, we have Sarush. I'm going to allow him to talk.
Sure.
His microphone has appeared and he can come in and talk.
Okay.
If not, he said he would type in the questions. So we'll bring him over. It says I can allow him to talk. So I just want to make sure he can come over.
Yep.
Just unmute yourself, Sarush, as you come in. Thanks for coming over, Sarush.
Hey, Sarush, how are you?
Very good. And you?
Good. Thank you. Thank you for coming on the show.
Thank you for making this show in the morning. They're incredible, super educational.
Oh, thank you. Really appreciate that.
So yeah, I had a question regarding, is it better for a trader to be 100% quantified with advanced mathematics and coding, or is it better to stay more on the discretionary side and self-decision making?
So I think that, are you asking for a trader, is it better to be just completely mathematical coding or more of like analytical of the markets?
Yeah, exactly. Is it better to rely on a model that is written with super like hard and concrete math and back tested multiple times, or is
Right.
it better for it to go more as a personal decision making on a day-to-day basis?
Right. That's a good question. Because a lot of the models that we create when we create models have, data. Usually it's math driven. Some of it is then logical driven. Obviously, like models also have like logic and algorithms in there, but ultimately any model that I've ever experienced. Okay. And I think it would be the same even for models like market making models that are algorithmically, electronically always updating. That there's always a person there watching those parameters and still making decisions and tweaking. So there's no such thing as a completely like a black box model that mathematical model. If you turn it on and never look at it and it's just going to like turn out money. I've never seen, even as far as regulation goes, so if you're an intermediary accessing the markets electronically, right, through directly, they're going to ask you, where are your parameters, where are your risk management tools, how are you making these decisions? So you can't, you can't separate those. They really kind of go hand in hand because the models and the programs are just tools there to assist us, right? But ultimately, the trader is still making those decisions and tweaking those parameters, right? So there's almost every model I've ever seen, whether it's like algorithmic, programmatic, whatever, there are people, sometimes teams of people evaluating them, monitoring them on a continuous basis, and changing the parameters, when needed, right? So, and sometimes the parameters there could be a lot of them, right? So, but if you're trading even electronically, you cannot remove the human touch completely. Like, is that it?
Right.
The question, that there's still going to be a lot of human interaction involved into that model. And models usually, are, there's no like perfect one that you could just say, here's the perfect one and it'll work forever. You're making improvements, right? As you evaluate it over time, you're making improvements to it.
And they probably also have life cycles, right? Like
They'll have,
some trades that you've modeled for and stop working.
So you're creating, right, but you're building on top of that experience, right? So sometimes you have to shelve models that work and don't work anymore. But you're building on top of that experience. You're constantly evaluating on a daily basis, on an intraday, on the weekends. You're going back there trying to evaluate the errors and improve those errors.
Got it. So it's better to have one, but not 100% blindly rely on it.
Well, I think if your question is it better to have a model or to have like human interaction, I think they would go hand in hand,
Okay.
right? You wouldn't, and the models are created by humans, right? So if you create a model that you want to trade, you're trading it the way you envision it, right? Not somebody else, but the way you're envisioning it, the way you're anticipating it, and you have to make those corrections as you go forward, right? Because you're making corrections even based on your own assumptions, right? You could be making assumptions, and going forward, you're looking at the results and saying maybe those assumptions were not correct, or I see how this works, or this is what I didn't compensate for, and you're making those corrections as you go forward. But there's always human decisions and human interaction involved. Just the models help along, they're tools. They help answer questions. And sometimes they're, even if they're trading for you, you're still monitoring them. You're still, you're still in control of them. They're just assisting you because they could see more than you, right? They could see and calculate much faster than the human brain.
Yep.
But you're still in control of them.
Okay, got it. Okay, perfect. Thank you very much. That answers the question. Makes many things more clear, because I was trying to rely on it 100% model based, but it was some situations like the flash crash, the 2000, the COVID crash, and all of that the model cannot really take into consideration. So I was to look at, okay, maybe I can put some ideas with the IV rank and the applied volatility, but that's still the human touch. It's still needed.
Still needed, and the models are not perfect. You have to understand how, because the models are just, you give it input and it gives you an output. It doesn't even know, the model doesn't even know how you're going to apply it, right? It's just input versus output. So you have to really understand the model and even be careful with your models. When you're using models, like for example, I'll give you guys right now. So, I'm running a model right now and I'm watching how relationships change as you raise interest rates, right? So right now, interest rates are going up. We're at zero for a long time. And there are relationships between certain assets that exist, but those relationships start to change as interest rates move up, okay? And even though I'm modeling out those relationships, right now we've reached interest rates 5.25%, right? Or 5.5%. Well, the problem with that is if your data only saw the relationships between 0 and 4%, we never had the 5.5%, right? In this current environment. So I can't interpolate it going forward. Like what if it goes to 6% or 7%? Well, I don't have that data, right? So if I don't have that data, even though I have a model, my model, I could input 6% into the model and it'll give me an output. I could even input 7%. It'll still give me an output. But the problem is that in reality, I don't have enough data because my data doesn't have 6 or 7% yet, right? So these are not data points that I can model out. And you have to be careful because if I put in 6%, my model will give me an output. But what does that mean? How much should I trust it? Because when in the training model, in the validation model, in the testing model, it never had 6 or 7%, right? So you have to also be careful with like how these models, and the models don't know what's going on. If there's other circumstances that are impacting the market, like you said, if you're in COVID, well, the models don't have that type of data, going through COVID. So sometimes you just have to say, hey, this model is not going to, it's not going to be good, right? I can't use this model in this environment.
Got it. Yeah, perfect. Thank you very much. Very appreciated.
Yep. All right. Thank you, Suresh. I really appreciate the question.
Thanks for coming on. We'll talk to you later, Suresh. Bye-bye.
It was a pleasure. Thank you. Bye.
Right.
We did have another question, D.
Sure.
And it came early. Let me go get it. We had someone asked, I want to know if Dimitri can explain how to best interpret volatility skew for a stock. He's like, could you use an example like Apple or Qualcomm? Look at the volatility skew and how do you interpret it?
So when we look at, okay, let me just come down here. Let me start out just showing people what, volatility skew is. I'm going to come out for a little bit further, and this is Apple. And when we when we calculate the implied volatility of, we use an option pricing, right? To calculate implied volatility, we have to use an option pricing model. That's what it does. It takes the price, right? It takes the price of an option and says, if we input this price with this many days to expiration, with this interest rate assumption, this dividend assumption, it does have assumptions in there, right? It's not a perfect. And we use the log normal distribution. And what is the implied volatility of that particular price, right? That's what we're looking at. This 670, it has its own implied volatility, just like the offer has its own implied volatility. So since every option can be inputted and calculated, the implied volatility, which, by the way, implied vols are dynamic because that's stock price change, more time decay, whatever, all this is changing. If we calculate the implied volatility using the option pricing model, well, now we have all kinds of implied vols, right, for different options. So remember, the stock itself does not have an implied volatility, right? If I just take a look at Apple, well, there's no way of calculating Apple's implied volatility. The option pricing model it needs an option, right? So we have to look at the options, right? So the options are the things that have an implied volatility, right? This price implies this volatility. And when we compare all these options, well, we have all these different vols, implied vols, because we have different prices, we have, different supply and demand for each option. So we got all these different implied volatilities to look at. And if they're all the same, right, then we could say, if they're all exactly 19.1, right, then we'd say there's no skew. All the options imply exactly the same implied volatility according to the option pricing model, right? But they're different. And when they're different, we could observe, what are the differences and what is this imply? All right. That's what we're kind of like looking at. Well, if here in Apple, right, we see that the implied volatility, or around where the spot is right now, is, let's say, 19.8, between 19.8 and 20. And as we increase, just looking at it, right, we're just looking at the options chain. Just looking at it, we had like a small dip here, which this could be really, maybe even this is the at the money if we calculate the forward price. I don't know. That might be at the money. So as the strikes are going up, the implied vols are starting to increase. All right, so let's keep that in mind. Strikes are going up and the implied volatility is starting to increase. And the same thing going down. Like, let's look at that first. We start at 19.4, and as the stock is going down, the implied volatility is increasing. So a couple things then, key takeaways here. If we observe that the implied vols were coming in, the assumption would be, well, that means the markets are implying as the stock increases, it will increase at a slower rate and volatility is going to slow down in the stock, right? The stock is going to increase, but at a very slow pace. That's what the options are implying. That's what the supply and demand is. So why would implied vols come in? Well, they're probably people putting offers on the book, trying to sell options for premium or, against their positions. But here we don't see that. We see that the implied vols are coming in, indicating that there are buyers, right? There are buyers, because how do you push, options premiums higher? Well, you need buyers, right? You need buyers to push them higher. And if they're buyers, they're, on the other side, probably the dealers are the ones having to sell them, right? Because the dealers ultimately are moving those prices. So in this interpretation, the market is saying, hey, you know what? If it goes up, if it starts breaking through here for whatever reason, then around these strikes, there's less resistance, right? It could move faster than at its, if it stays in its range, right? If it stays in this predicted range, the volatility will be lower. If it breaks out of the range, it could start moving fast at a faster clip, at a faster volatility, more volatility. In other words, it might, even if it might not move all the way through, but as it's going through the volatility fluctuations, it's going to be less liquid, right? Less resistance, maybe less stocks offered up there. And could be for many, it could be people buying the options. Number one, so people are buying the options. The dealers, obviously, if they're selling it, they're going to start hedging those options as it's breaking through. Or it could be the dealers are pushing up these options themselves because they're looking at the depth of the order books themselves, right? They're looking at the depth of the order books, where they're seeing, hey, you know what? There might be a lot of stock clustered around these strikes right now, bid and offer, right? But if we break through, they don't see the usual amount of stock offered up there, right? So they're worried that, hey, if we break through this, we don't see enough supply of stock out there that it could start moving much faster. So that's so that's what we're interpreting. Well, how is this skew lined up, and what can it potentially be indicating or signaling to us? And here, if I'm just looking at this, without a much further analysis, it's telling me this following, that if we move away from this cluster of, trade this range over here, right, that between now September 15th, that we're looking at, if it breaks out, that the volatility will start increasing if it starts to break out through these strikes.
Nice job, Dimitri, and thanks for the question from a new chameleon. That was great. Super helpful. And Sarush, thanks for coming on today. These live questions really make for a great show and really help the entire community, which is always awesome. Great job, Dima.
Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.